Hey everyone, and welcome back to Money Journey. Today we are diving into a situation that every value investor dreams of or fears. UnitedHealthcare Group, a healthcare giant that has been a steady performer compounder for years, has seen its stock price absolutely plummet. It's down over 50% year to date, a decline that has made many headlines and set shockwaves through the market. Is this a falling knife you should avoid at all costs, or is this the moment to seize an incredible opportunity? We are going to put United Healthcare under the microscope, analyzing its business, its competitive advantage, and its fundamentals to determine if this is the perfect time to invest in a company that has never been looked so cheap. United Healthcare is a behemoth in the healthcare space, but its business model is more complex than just selling insurance. It operates through two primary segments: United Healthcare, which is its traditional health insurance business, and Optum, its healthcare service arm. The real magic and the core competitive advantage lies in the synergy between these two. Optum provides a range of services from pharmacy benefits to data analytics and even direct patient care. This integration allows United Healthcare Group to manage costs, improve patient outcomes, and create a powerful ecosystem that is incredibly difficult for competitors to replicate. However, despite this strong business model, the company's stocks has been under pressure for several key reasons. First, rising medical costs have squeezed profitability. The company is paying out significantly more in claims than it anticipated, especially in its Medicare Advantage plans. Second, there are ongoing DOJ investigation and regulatory scrutiny, which creates a cloud of uncertainty. And finally, the company itself has had to slash its earnings outlook, signaling to the market that its operational challenges are real and not just a temporary blip. And about United Healthcare fundamentals. Market cap of $227 billion with sales above $400 billion. Trading at the P under 11 and the price to free cash flow under 9 looks very attractive right now, especially if you look to the stock performance. Right now we are almost at 2020 COVID lows, so it traded above $600 last year, and right now it's at just $250. It looks incredible. Let's evaluate our Money Journey checklist with the most important fundamentals. Revenue growth, check mark, growing revenues around 10% per year, which is very good. Market potential, industry growth prospect around 8.7%. This industry, healthcare insurance industry, is expected to grow around 8 to 9% in the next few years. So it is good growth, very high recurring revenues, which is very good. In terms of revenues, it was what I was saying: recurring subscription, high quality. If you look to the graph of revenue, for example, since 2018, it's almost more than double their revenues, growing each and every year very steadily, high recurring, which is very good. It's something we like to see. So this is very predictable company, so that deserves a premium just for that. So it's expected the healthcare sector to continue to grow in the next few years. I expect that, and the analyst as well. So this is good to see. In terms of product process development, it's a yes. They have their Optum division. They are not creating new products, but they are creating synergy with Optum Health and their healthcare insurance business, trying to grow vertically. So that's a good. And research and development, their efforts have been very good for investors. Their returns on equity on an investor are above 20%. Return on equity is around, if you look to that, last year was a fluke since profitability was going down, and this year 2025 probably will be around that as well. But overall, at average, around 25% return on equity, and return on invested capital is very good as well. So that would say their capital employed in equity or in investment has been very good, so it's very effective. Operating margins, profit margins are not high for other company standards. I would say we prefer companies with higher profit margin, gross margins above 50%, net profit margins or free cash flow margins above 20 or above 15%. But for an insurance company, if you compare to competition, they have really great margins, very much Elevance, Humana, that the insurance competition that UnitedHealthcare have as profit margin, free cash flow margin of 2 to 3%. In the last decade, UnitedHealthcare has profit margin between 6 to 7%. That's due to the synergy they have with Optum Health, for example, which is a high margin business. But still, they have the best insurance margins when compared to all the competition in the US. So I would say even though it's an X in terms of margins overall, they have the better margin in this business, and they have high sales, high revenue, so they earn a small profit in everything. They have free cash flows above 20 billion, which is very good, so it's a huge company. They have been maintaining profit margins. If you compare last year and this year, they are not maintaining. Free cash flow margins are down from 6-7% to 5-4%. But this is a fluke, a temporary headwind, I would say, since high medical costs and some claims they were not expecting. But since they have pricing power, they will increase their pricing in the next year, and we expect profitability to return to normal levels. I would say between 6-7%, around 6 probably. But this is very good sign for companies to maintain their profit margin, even though UnitedHealthcare are not maintaining. But I believe in the future, if you look to 2026 or 2027, they will be maintaining their margin. And this is just a temporary blip. In terms of margin versus competition, they have better margins. It was what I was saying before. Pricing power, yes, they are the biggest and best insurance company in the US. There are plenty of clients, so they will continue to increase their pricings, the number of clients. In terms of debt, their balance sheet, their cash, they have $28.5 billion and a long-term debt of 73.5. So net debt of negative $45 billion. But if you look to the free cash flow, they have been having in 2022 $20 billion free cash flow, 22 in 2023, 2024 it's just $14 billion. But with normal levels, they could pay all their net debt with 2 years of free cash flow. So I would say, and they have better debt ratios when compared to competition. Their debt storage and balance sheet is pretty safe. In terms of rates of return, very effective company. High returns on equity, around 24%, the average number of the last decade. Let's evaluate now management, which is very important. They are having some problems in the management. They changed CEO recently. These claims they were not expecting is not the best thing to see management do or expect. They should be expecting that. But overall, they are very competent. They are not just, they are almost extraordinary. If you look to their track record, high returns on equity and on investment, they've been growing really good. They are beating the S&P 500 and other tech companies, for example, in terms of performance. So it's very good. In terms of culture, reputation, it's average. There are some problems, even though their management is very good. And they are the best and biggest healthcare insurance company in the US. There's some news coming that they are not accepting some claims, trying to difficult the life of their clients, but that's bad in terms of future prospect, maybe but they're doing what's best for the shareholders, just trying to maximize their gains and margins. So even though that could create some problems in the future if their reputation took a hit, So that's why I say that's average, and I would like to see a better relationship with the clients, and seeing clients praising the company, loving their product. But their product is based on they need it, they need insurance for their healthcare, so they have to continue even though they don't like, or they don't like to do the claim. So I'll say that their moat is that network effect, efficient scale. US citizens have to have health insurance, so they will pay for that. They will continue to grow. The demand will continue to grow. So that's a very good competitive advantage. And then there's synergy between Optum Health and the UnitedHealthcare group, having the best margins. Difficult to it's very difficult to compete with UnitedHealthcare in the insurance business. In terms of free cash flow per share growth, it's a check. Even though we are just seeing 5.6% per year growth, in reality, if you exclude the last year 2024, they have been growing around 10%, which is very good growth. This is, as I've said, just one-off year, and probably 2025 will be a low profitable year. But after they use their pricing power, increase their prices, and go to normal levels, I would say that we'll see the resume of free cash flow per share growth, around 10% per year. And they've been returning capital to the shareholders. They pay a dividend right now, it's around 3.4%, and they are doing some buybacks around 1% per year. So they have a wide moat, returning capital, and with that, a really great company, a quality score, fundamental score of 70 out of 100. Bear in mind, above 50, it's a score that shows very good fundamental companies. Above 70, really great companies. And if you look to like 85 or 90 out of 100 score, it's the best companies you see, almost perfect companies or business models. Questions to ask. Is this cheap? Is UnitedHealthcare Group cheap? We have to do our discounted cash flow, but up to now, it's never been so cheap in a decade, and growth prospects remain intact. Is it a good business? 100% sure. Who's running it? They changed the CEO. Right now, it's the return of Stephen Hemsley, which was the CEO before. So what am I missing? This is my thesis, investing in UnitedHealthcare. It looks cheap, high quality business. What am I missing? Their criminal process with the DOJ can result in high penalties. There are other cases, Meta, Wells Fargo, for example, which had DOJ criminal process before, and right now they're at all-time highs. It's all solved. The US government always try to do the best for their companies. That's why the US deserves this premium, and it's the best place to do business. So probability wise, I would not say we'll see high penalties, or UnitedHealthcare will not recover because the DOJ will not end this process. It will be solved, maybe paying a fine, but overall UnitedHealthcare has already this problem discounted in their stock price. Government limiting profit margins. UnitedHealthcare has margins better than the industry averages, so government could try to reduce their margins. I do not think that we'll see that in the US because they are pro-business usually, but could be a risk for UnitedHealthcare. And high medical cost affecting margin, yes, it's a headwind that happened last year and 2025, but their pricing power, they will be increasing their prices, so we might see the resume of high profitability in the next few years. So at least it's my thesis. In terms of sources of return, we will see revenue and earnings growth for sure. Revenue, it will be growing. We don't expect any slowdown in healthcare demand in the US. Earnings grow, definitely. This is a slowdown. Earnings, free cash flow decline. in 2024, and we are expecting to see that lower level at 2025. But after they're increasing their prices, we'll see free cash flow resuming growth and closing to the overall trend of the last decade. So I'm expecting that. P expansion, definitely. A company like UnitedHealthcare doesn't deserve a P of 10, especially for the quality of this business. Then we are seeing management doing buybacks and dividends, paying a dividend of 3.5% almost, doing buybacks of around 1%. This is cash profits that are returning to the shareholders, and they have been very shareholder friendly. But the question is it cheap? I do really believe, at least in terms of P ratio, but let's do our discounted cash flow. US company, very safe company, so my discount rate for my base case will be around 9.5%. Discount rate for the next 7 years. Free cash flow margins, I'm expecting around 6%. It's my lower base. They could have 7% margins in the future. They already had that in the past. In terms of growth rate, they are expecting to grow revenues of in 2025 around 12%, and in 2026 5%. Industry is expecting 8.7% growth in earnings per share per year. So I'm expecting in my base case just 6% growth. I'm being conservative. In terms of future P, they deserve a premium. This high recurring revenues, leader in the business, the biggest health insurance company in US, highly trusted by clients. So 18 is a good P. I think they deserve it. So with that, I have my bull case and bear case, and with all these assumptions, I came with an intrinsic value of $550. Right now, UnitedHealthcare is trading at 250, 50% margins of safety. We can find companies trading at with the margins of safety, and bear in mind, I have some margin of safety here, and this is high quality company. I think they deserve a very big premium. It's usually we could find companies trading at a 50% margin of safety, but not companies market leaders like UnitedHealthcare. So in theory, this looks like a very good opportunity, and that's why UnitedHealthcare has been trending in the social media, Twitter and YouTube in the last few days. So, what's the final verdict? We have seen that UnitedHealthcare is an exceptional company with a powerful and well-managed business model. Its dual segment structure of UnitedHealthcare and Optum Health provides a significant competitive moat and recurring predictable revenues. And with the stock down over 50%, it looks incredibly cheap, especially when you consider its long-term growth potential and strong fundamentals. But the question remains, can the company navigate its current challenges? Can it get a handle on rising medical costs and emerge stronger from the regulatory scrutiny? I'd love to hear your thoughts in the comments below. Do you think UnitedHealthcare is a bargain or is it a trap? Let me know. And if you want to stay up to date on all the best investment opportunities in the market, be sure to hit that subscribe button. Thanks for watching, and I'll see you in the next video.
This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.